Hi and good day to you, my respectful lecturer. So I'm Kabilan Rajasekharan here. Today I will be presenting on the financial ratio analysis of the Telecom Malaysia Berhad for the past years of the 2024 and 2025. So this analysis will cover four categories, which will be the liquidity, asset management, debt management, and profitability. So before moving to these subtopics, I would like to also give a quick introduction of the Telecom Malaysia. It also very well known for the TM. It was established in 1946 and the headquarters is located in Kuala Lumpur, Malaysia. It is one of the most leading, a very famous company for the telecommunications and by providing a wide range of digital and communication services. So below the points are the invention of the telecom company, which is fixed line and telephone services, high speed broadband through the Unify, and mobile services. Also they have invert TM of they offer computing data center services, cybersecurity, and Internet of Things, and also digital ICT solution for the business through the TM1. Not only that, the company also provided international connectivity through the TM Global by supporting both local and global communication needs. So now we move to the next slide, which is I'm going to explain about the main analysis, the four categories about the TM. Okay, so for the first element will be the liquidity ratio. Current ratio is a measure the company ability to meet the short-term obligation in the 2025. So we just focus on the 2025 column only. So the current ratio was the 1.08 time. It means the TM had a RM 1 ringgit 8 cent of the current asset of for every 1 ringgit of their current liabilities. So it indicates the company maintained a satisfactory liquidity position. The next will be the quick ratio, which is excluded inventory from the current asset was the 1.03 time in the 2025. So it shows that the TM could meet the short-term liabilities using it most liquid assets without relying on the inventory. The second element will be the asset management ratio. Moving on the asset management, the first point will be the inventory turnover ratio was shows 5.21 time in the 2025. It means the company inventory was sold and replaced about a 5 time during the year and indicating the moderated inventory management efficiency. The next will be the receivable turnover ratio was the 0.12 times, suggesting the company collected a payment from the customers at the relatively slow pace. So moving to the third point will be the total asset turnover ratio was the 0.08 time. It indicates the TM generate only 8 cent of the sales of every 1 ringgit invested in the total asset. So it's reflected relatively low efficiency in the utilizing its assets. Final point will be the average collection period was the 111 days. So 111 days, it means the company took approximately 111 days to collect the outstanding receivable from the customers. The third element will be the debt management ratio. For the debt management ratio, the total debt ratio was 18%, which means the only 18% of the company's assets were financed by the debt. This indicate a low level of financial risk. And the next will be the time interest earn ratio was 6.040 time. It shows the TM earn a more than 6 time interest expenses. This also display the company's strong ability to meet an interest obligation. The fourth element will be the profitability ratio. Under profitability ratio, current on the asset was 8%. It indicate the company generated only the 8 cent in the profit for the every 1 ringgit invested in the total asset. And the final will be the return on equity was the 16%. It means the TM generate the 16% on the shareholders investment, reflecting the satisfactory return to the investors. For the net profit margin, the result of the calculation was 104%. However, these values are unrealistic because the net profit should not be exceeded a sales revenue. Therefore, this suggestion that the sales figure used in the calculation should be reviewed.
I'm presenting my financial analysis assignment on Sasbadi Berhad. To give you a quick background, Sasbadi was established in 1985 and its headquartered in Petaling Jaya, Selangor. Over the last 4 decades, they have grown into a leading cornerstone of Malaysia education sector. Their core business spans traditional education publishing such as school textbook, reference book, and workbook, as well as supplementary material and general title. For their future evolution, Sasbadi was aggressively diversified into digital learning platform, e-learning solution, interactive teaching aids, and robotic program for school. This strong, diversified market presence provides the baseline foundation for the financial result we are analyzing today. Let's start with short-term financial stability in row 1 and 2. For Sasbadi, current asset ratio saw as contrast shift from 4.05 times in 2034 down to 3.20 times in 2025. Quick ratio adjusted from 2.07 times to 1.73 times. Even with this drop, this liquidity level indicated that Sasbadi remains in safe position to cover all short-term publishing. Moving on to efficiency in row 3 through 6, this is where Sasbadi publishing supply chains optimization really shine. The inventory turnover improved from 1.01 to 1.12 times, while receivable turnover rose from 1.27 to 1.34 times, showing that Sasbadi Berhad moving print material faster. The most win Sasbadi is average collection period. It dropped from 166 days in 2024 to just 106 days in 2025. They save off 16 days from collection cycle with education distribution and government textbook contract, unlocking massive amount of cash flow back into business. Now look at average metric in rows 7 and 8. Sasbadi total debt ratio did increase from 4% to 10%. However, look at the strength of their operation. Time interest earns ratio from 2.74 times in 2024 to 70.3 times in 2025. This explosive 2025 performance proof that Sasbadi operating profit are now massive enough to pay off financial borrowing obligation nearly 70 times. While 2024 was a tight year for Sasbadi due to post-pandemic, 2025 marked a massive earning expansion. Net profit margins serve are from 3% to highly 40%. These margin expansions directly create immense value for shareholders. Such-body returns on asset grew from 1% to 4%, and return on equity jumped from 1% to 6%. Let's start with short-term financial stability in row 1 and 2. For Such-body Berhad, current asset ratio saw a controlled shift from 4.05 times in 2024 down to 3.20 times in 2025. Quick ratio adjusted from 2.07 times to 1.73 times. Even with this drop, this liquidity level indicates that Such-body Berhad remains in an incredibly safe position to cover all short-term publishing and corporate liability comfortably. Moving on to efficiency in row 3 through 6. This is where Such-body Berhad publishing supply chain optimization really shine. Inventory turnover improved from 1.01 to 1.12 times, while receivable turnover rose from 1.27 to 1.34 times, showing that they are moving premature faster. The most win for Such-body Berhad is average collection period. It's dropped from a heavy 166 days in 2024 to just 106 days in 2025. They save off 16 days from collection cycle with education, distribution, and government textbook contract, unlocking massive amount of cash flow back into business. Now let's look at leverage metric in row 7 and 8. Such-body total debt ratio did increase from 4% to 10% as we strictly utilize funding to drive digital education scaling. However, look at the strength of operation. Time interest earned ratio from 2.74 times in 2024 to 70.3 times in 2025. This 2025 performance prove that Such-body Berhad operating profit are now massive enough to pay off financial borrowing application nearly 17 times over. Profitability and investor returns. Finally, let's analyze bottom line profitability. While 2024 was a tight year for Such-body due to post-pandemic adjustment, 2025 marked a massive earning for Such-body Berhad. Net profit margin surged up from 3% to a high 14%. This margin exposed directly create immense value for shareholders. Such-body return on asset grew from 1% to 4%, and return on equity jumped from 1% to 6%. That prove that Such-body Berhad are maximize investor return effectively.
Good morning, everyone. Today I will present the financial statements analysis of Green Packet Berhad. Green Packet Berhad is a company listed on Bursa Malaysia under the telecommunication and media sector. The company provides digital services, cloud solutions, and telecommunications. This analysis compares the company's financial performance between 2024 and 2025 using financial ratios. The analysis focuses on 4 areas: liquidity, efficiency, debt management, and profitability. This slide shows liquidity and efficiency ratios of Green Packet Berhad. First, the current ratio and quick ratio both decreased from 1.30 in 2024 to 1.06 0.08 in 2025. However, both ratios remain above 1.0, indicating that the company was still able to meet its short-term liabilities. Next, inventory turnover and total assets turnover decreased, suggesting that the company has become less efficient in utilizing its resources. Receivables turnover also declined from 4.08 to 3.95 times, while the average collection period increased from 89.46 days to 92.41 days. This means the company took slightly longer to collect payments from customers. Overall, the efficiency of Green Packet Berhad weakened in 2025 compared to 2024. This slide presents the debt management and profitability ratios. The total debt ratio decreased from 0.78 in 2024 to 0.72 in 2025, indicating that a smaller proportion of the company's assets was financed by liabilities. However, profitability became weaker. The company continued to record losses, resulting in negative net profit margin, return on assets, and return on equity. Although the times interest earned ratio improved slightly, it remains below zero because operating earnings were still insufficient to cover interest expenses. Overall, the profitability of Green Packet Berhad deteriorated in 2025 despite a slight improvement in its debt position. In conclusion, Green Packet Berhad remained capable of meeting its short-term obligations because its liquidity ratios stayed above 1.0. However, the company's operational efficiency declined, as shown by lower turnover ratios and longer collection periods. Profitability also weakened due to larger losses, resulting in negative profitability ratios such as net profit margin, return on assets, and return on equity. Overall, the financial ratio analysis indicates that Green Packet Berhad experienced weaker financial performance in 2025 compared with 2024. Thank you.
Hi, good morning everyone. Myself Ashwin. Today I would like to introduce Redstone Digital Sdn Bhd, one of Malaysia's leading integrated telecommunications and digital solutions provider. Redstone Digital was established in 1996 and has over 2 decades of experience in the telecommunications industry. The company is a subsidiary of Berjaya Corporation Berhad and is listed on the Bursa Malaysia main market, which reflects its strong reputation and financial credibility. The company provides end-to-end telecommunications and digital solutions for business and government organizations throughout Malaysia. Their service includes managed network services, cloud computing, Internet of Things, and cybersecurity solutions. These technologies help organizations improve operational efficiency while ensuring secure and reliable communication. Redstone serves a wide range of customers, including government agencies, large enterprises, and small and sized enterprises, also known as SMEs. By offering customized digital solutions, the company supports organizations in adapting to the fast-changing digital environment. The company's main objective is to enable digital transformation by delivering reliable, secure, and innovative technology solutions. As business increasingly depend on digital infrastructure, Redstone continues to play an important role in strengthening Malaysia's digital economy. Overall, Redstone Digital has built a strong position in the telecommunications industry through its commitment to innovation, customer satisfaction, and continuous technological development. Thank you. Next, I will present the financial ratio analysis of Redstone Digital for the year 2024 and 2025. This slide presents the comparison of Redstone Digital financial ratios between 2024 and 2025. Starting with liquidity, the current ratio decreased slightly from 2.55 times in 2024 and 2.40 times in 2025. Similarly, the quick ratio declined from 2.54 to 2.39 times. Although both ratios decreased, they remain above 2, indicating that the company still has sufficient current assets to meet its short-term obligations. Next is asset management. The inventory turnover ratio decreased from 541.41 times to 439.68 times, while the receivables turnover ratio fell slightly from 11.16 to 10.79 times. However, the total assets turnover ratio improved from 0.73 to 0.81 times, showing that the company generated more revenue from its assets. In addition, the average collection period improved significantly from 141 days to only 90 days, meaning the company collected payments from customers much faster in 2025. Looking at the debt management, the total debt ratio increased from 3% to 6%, but this level remains relatively low. The time interest earned ratio decreased from 27.84 times to 9.30 times, indicating that the company ability to cover interest expenses became weaker, although it is still capable of meeting its interest obligations. And finally, for profitability, the net profit margin decreased from 26% to 13%, while return on assets declined from 13% to 6% and return on equity fell from 20% to 10%. This result suggests that although the company improved its efficiency in utilizing assets and collecting receivables, its overall profitability declined in 2025. In conclusion, Redstone Digital maintained strong liquidity and operational efficiency but experienced lower profitability and weaker interest coverage in 2025 and compared to 2024. That's all from me. Thank you.
Good day to respectful lecturer and my fellow friends. Today I am going to present about Astro. So the Astro Malaysia Holdings Berhad is one of the leading media and entertainment companies in Malaysia. It was founded in 1996 and it is headquartered in Kuala Lumpur. Astro is listed on the main market of Bursa Malaysia. So the company provides pay television streaming, broadband, and radio services through platforms such as Astro TV, Astro Go, and Soka. And also, the Astro generates its revenue mainly from subscription fees, advertising, and digital services while continuing to focus on delivering quality entertainment and local content to Malaysians. Thank you. Good day to everyone. So I wish to continue my part, which means Astro Company financial ratios. So based on financial ratio analysis, Astro Malaysia Holdings Berhad showed an overall improvement in 2025 compared to 2024. The company profitability increased with the net profit margin rising from 1% to 5%, while return on assets and return on equity both improved to 10%. The total debt ratio decreased from 27% to 23%, indicating a strong financial position. So the asset turnover also increased slightly, and also although the inventory turnover declined and the average collection period became slightly longer. Overall, Astro demonstrated better financial performance and improved operational efficiency in 2025. Thank you. Good day to everyone. So I want to continue with my part, which means the overall performance. So in 2025, Telecom Malaysia has recorded an average financial performance. So the company maintained adequate liquidity with a current ratio of 1.08 times and a quick ratio of 1.03 times, showing it can meet its short-term obligations. However, its liquidity was lower than Redstone Digital Berhad and Saswadi Holdings Berhad. The company also showed a weaker operational efficiency with an average collection period of 111 days. On the positive side, Telecom Malaysia had a strong financial position supported by a low debt ratio of 18% and a times interest earn ratio of a 6.0. times. Overall, the company is financially stable but needs to improve its operational efficiency. So that's all from me. Thank you. Good day to everyone. So again, I continue with my part recommendation. So for Telecom Malaysia Berhad, I will recommend it as a good long-term investment choice because the company recorded a high net profit margin of 104%. It was a showing strong profitability and effective cost management. It also achieved a return on equity of 16%, which indicates attractive returns for shareholders. In addition, Telecom Malaysia maintains a low debt ratio of 18% and a times interest earn ratio of 6.40 times. It was also showing a strong financial position and the ability to manage its financial obligations. Overall, Telecom Malaysia Berhad demonstrated strong profitability, low financial risk, and stable performance. It was making it suitable for long-term investors. So that's all from me. Thank you.
So, the final slide of this presentation will be the limitation of using a financial ratio analysis. So, there are two limitations. For the first limitation will be the historical data. Financial ratio are calculated using past financial statement like 2004, 2024, and 2025. So they reflected a past performance rather than the company current or future performance. Change in the economic or market condition may affect their future result. So the second limitation will be the qualitative factor. Financial ratio are only measured financial performance and do not consider qualitative factors such as the management quality, customer satisfaction, employee skills, or a brand reputation. It also can influence a company to can bring a future success. Okay, thanks for listening to our speech. So hope you like it, and thanks once again.